Welcome once again to Wealth in the Winner's Circle with financial advisor Harley Shanklin. He is one of the co-founders of the RDW Financial Group. I am Spike Spangle. Harley, how are you this week?
Excellent as always, Spike.
Well, that's good to hear. That's good to hear. As we like to play with the analogy and being around the greater Indianapolis area here, Wealth in the Winner's Circle, we want to downshift into retirement. That's fun. What do you mean by that, though? What do you mean by downshifting into retirement?
Well, downshifting into retirement, what we mean by that, Spike, is the idea that we have to start taking a different approach. We have to have a different strategy as we near the end of our working life, or that race that we're running, to prepare for the retirement race. And the fact of the matter is the Indy 500 provides a great example of an analogy to how we need to change things, because when those drivers are out there on the course running those first 400 miles, their strategy has to start to change as they come into that last part of it, because they don't want to run out of fuel, they don't want to burn out the tires, get in a wreck, anything like that. And it's the same thing when it comes to our retirement, is we want to be able to start taking a step back, taking some of the speed off of our investments, pulling back some of the risks that we're taking on those investments so we don't run out of gas or we don't crash and burn right before the finish line.
I do love the analogy, but I've got to ask you this. We've also talked about longevity. So just the opposite side of this coin, if you will. If we completely are taking off risk before we get to the finish line, well, here's the thing. In retirement, the finish line isn't necessarily 65 or 66. The finish line is perhaps in our 80s or 90s. So how far are we downshifting in our 60s?
Well, that's the thing, and you're exactly right. That finish line in some ways is actually the start line. It's the start line for that next journey in our life going into retirement. And we don't want to take all the risk off the table. That's not a smart move either. We just want to be able to take a more controlled approach to it, whereas in our working lives, we're saving money. We're taking advantage of that theory of dollar cost averaging.
Mm-hmm. Yeah.
And through that time period, what that really says is if we consistently save over time, that dollar cost averaging, we're going to buy into the market more when it's down than when it's up, and thus buying in low when it's on sale. Well, when it comes to retirement and we're getting ready to start drawing from that money, we still have to deal with the same market movements that we did when we're taking advantage of that dollar cost averaging. So now in retirement, rather than putting money in consistently, we're taking money out consistently.
Yeesh.
So if we're working on that same timeline, what are we going to run into? Statistically, we're going to draw money out more when the market's down than when it's up.
Okay. Now, and I agree with you. And that's if we also don't have some version of plan. I would think that you probably want to get a portion, certainly of that spending money that we're going to use in that year, that next year, the third year. Probably get a little bit of that off the table, or at least somewhere else, or someplace that isn't quite as exposed to the up and downs of the market. But then again, I go back to my same question. We're not completely taking everything that we saved into 401ks or 403bs and just putting it over into cash, because we've got to have some version of growth. I think the harder thing for many of our viewers out there is separating into different, whatever you want to call, timelines or buckets of money. Your life savings doesn't have to all be saved or invested the same way, right?
No, exactly right. And actually, we have some clients, John and Jane, who I can think of right now, who, when we initially sat down, it was pedal to the metal. Year out from retirement, everything was towards the stock market. And John, that's just who he was. He wanted all that market risk and the gains and kind of excitement that came along with it, as opposed to his wife, Jane, who was not on that same track. She knew that they needed to take some steps back. And John was fairly hesitant about it. But when we were able to sit down, take them through that retirement start process where we look at the secure income, tax efficiency, advanced planning, risk management to build that tailored investment strategy, we were able to show John, here's the power of actually taking some of that risk off. And coincidentally enough, the next year after that we did that, the market wasn't so good. And you know who was real happy about that? John was real happy about that we were able to take some of that risk off. And it presents the opportunity that when the market drops down and we've taken some chips off the table, so to speak, we can throw a few more in when the market is down and be able to buy in when it's low and ride that wave back to the top.
Yeah. Perhaps you can explain, if somebody is watching the program for the first time, exactly what the START process is, because we're talking about downshifting and retirement. Well, you're starting, though, your retirement years. The investments are very, very important. We want to make sure that we're downshifting the risk. We don't want to take too much risk. But you could be in retirement for 25 or 30 or 35 years, if not yourself, maybe your spouse. We want to make sure that you've got a plan for all of it. What completely is the START process?
Sure. Well, first, let's just start with the fact that it's hard to downshift without really understanding the how, what, when, or where behind it. There has to be a strategy, and that's where the START process comes in, where every letter of the word START stands for a different piece of it. The first one is secure income. That builds the foundation of our retirement out there. For all of you out there, it's your Social Security, your pensions, any sort of fixed income that you may have coming in, making sure that you're aware of when to take Social Security, how to take it, all of those things. Same thing with your pensions. Then we move on to the T, which is tax efficiency, making sure that you are being as efficient as possible with your taxes, income withdrawals, all those things. Not just today, but looking and forecasting out into the future to see what is that going to look like. From there, we move on to the A, advanced planning, or just another way of saying estate planning or legacy planning, where we want to make sure that your financial house, if you will, your financial vehicle is structured in such a way that when the good Lord comes a-calling, that it is going to pass to the people and in the way that you would wish it for. Then that our risk management, where we're looking at the risk to your life, health, and investments to make sure that it is in alignment as you begin to approach the finish line of your working life and the start line of your retirement life, to make sure that all of those things are in alignment. And then finally, we finish that up with the final T, tailored investment strategy. And that is simply looking at those four other areas of secure income, tax efficiency, advanced planning, risk management, to make sure that your investments are structured for you, not anybody else, not your brother, not your neighbor, but for you in the retirement race that you want to run.
Right. You can get started on your own START process for retirement right now. Your complimentary written financial plan is right here at this phone number. Call that right now. Folks are standing by. They'll schedule an appointment for you. There's no cost. There's no obligation. You'll sit down with the team and we'll get you started on the entire process of the retirement strategy for your future. Call that phone number right now. More with Harley Shanklin of the RDW Financial Group right after this.
We are a family-run organization. My son-in-law spent 10 years in the military. There was an opportunity, and I saw that desire in him to help people. He came alongside, and it's worked out phenomenally well. And my eldest daughter has now come alongside, and she does the operating side and the marketing side of the business. But all of my clients, they have given me their life savings. You know, if something happens to me, these people are going to need to be taken care of. I'm very blessed, very fortunate that evolution has now taken place, and I've got the next generation coming along. I know that regardless of what happens today, tomorrow, or hopefully a long time from now, that every person that I have in my firm, meaning my clients that I have formed a relationship, are going to continue to be treated and taken care of the way I personally have taken care and treated them for the last 25 years.
Did you know Uncle Sam might be your partner in retirement? It's true. If you have a 401k, IRA, pension, or similar retirement accounts, they're all tax targets. But how much? Get our easy-to-use tax calculator and plug in the numbers. Go to rdwtaxtest.com and find out your potential tax hit.
Welcome back to Wealth in the Winner's Circle with Harley Shanklin, financial advisor, part of the RDW Financial Group right here in the greater Indianapolis area. You know, what got you here, what got you to the end of the race in the top 10 we can say, is not necessarily what's going to win you the race and get you all the way through the finish line. How many times do people come into you and they say, well, I'm a pretty conservative investor. I don't like to take a lot of risk. You do a portfolio review and you see they're still in fifth gear.
100%, Spike. I would say 9 times out of 10 when we initially sit down with someone, they really have no clue as to actually how much risk they are taking. And that just really comes down to the fact that within these 401k plans, there's not a lot of education out there talking to you about what sorts of investments you may need to consider and what sort of risks may come along with those things. And the other part that we see is we see folks, they think, well, I have this one investment and that's a conservative piece of it. And what they don't realize is it's a basket of all sorts of investments within there. There is still some risk stuff in there. And many times it's overlaid or doubled up with risks that they're taking in other funds. And so it just kind of compounds itself. And so we do that portfolio analysis to see how much risk are you actually taking and how maybe can we restructure that so it is more efficient. So you're not taking the risk of a 35-year-old.
Yeah. This might seem pretty simple from your seat, but I would also imagine that, let's start here. Between couples, not everybody has the same risk tolerance. So if you're identifying somebody who's taking more risk and somebody who wants to take a little bit more risk, how do you get them into a 2-passenger retirement car together? How do you combine it together? Because maybe somebody wants to step a little more on the gas and somebody else says, I don't want to go that fast.
Well, there's an annoying question that comes along with a lot of meetings with us, and it's why? Why do you want to take that much risk out there? For those of you out there who are comfortable with that kind of risk or even want to take that kind of risk, my question is why? Why do we want to take that much risk if it's not necessary to achieve the goals that you want to achieve? If we can restructure your investment portfolio to not only sustain but enhance what you're already doing, why wouldn't that make sense? What is more risk actually bringing to your financial life aside from disagreements with your significant other, which, Spike, is never a good thing.
Exactly. Especially when it comes to money and our retirement planning. Speaking of, switching gears, switching tires, if you will, one of the things that you've said about this, and we're kind of downshifting for our retirement, it's not just a slowing down of lifestyle, it's a changing of lifestyle. Our retirement's going to be a lot longer. To be able to make it through, I think we're going to have to change our tires a little bit. We're going to have to change our strategy a little bit. The taxes. You've often said what got us here will not always get us to there. We've been saving tax deferred. A lot of folks have been saving tax deferred for decades. Is that the strategy we want to use all the way through our retirement years? Just keep deferring the taxes as long as humanly possible?
No. Now, when it comes to the tax conversation and the question of, what got you here, is that going to get you to where you want to go? 9 times out of 10, that's just not the case. And the question we often ask is, do you think taxes are going to be higher or lower in the future? Well, I think if we're all being honest, there's really only 2 right answers. And it's that, yes, taxes are going to be higher, or I don't know. And what we want to do is just take that out of the equation and start doing that tax planning today to put somebody in the best possible position. And through our working lives, many of you out there, you paid your taxes. You filed diligently every year. But all that really is a history lesson for you, telling you how much you made last year and how much you may still owe come April 15th. We want to take that a step further and do actual tax planning, not just tax filing, to see what are your taxes going to look like next year, the year after, 10 years from now, and then retrace backwards to see what can we be helping you to do today to help save you those taxes in the future.
Yeah, it's kind of changing of the tires. We've got to change that out. If you want to get all the way through the rest of the race, when you start burning out on those, you're going to start sliding all around the track.
And we've got a great way to show people through our retirement tax
What is
test.
That? Yes.
Yeah, so if you visit out there, rdwtaxtest.com, you can see it right at the bottom of your screen, or you can scan that QR code right down there that will show you what your actual tax bill may be. And Spike, we often tell people to do this while they're sitting down, right? Do it while you're sitting down, because I promise you will be surprised as to what that bill actually ends up looking like. But it's very educational, especially for pre-appointment time. That number down at the screen, which you've seen all throughout this show, you can call it, schedule a free consultation with us. If you have done that retirement tax test, we can make that the topic of the meeting to make sure that we go through that in steps that you can start taking today to help lower that for the future.
In fact, the show being interactive, you don't have to go anywhere. This RDW tax test down on the bottom, look, I know you've probably got your phone there. You can either open up your phone to one of the browsers and type that in, rdwtaxtest.com, and hit enter, or you can scan the QR code right over here, open up your phone to the camera function, and it'll take you there so you don't have to type anything in. Then you click on it. It's a few simple inputs. Yes, you'll put in your name, but this is just collectible information so they know where to send it off to. Then you'll put in an email address. Then you are going to put in what you think you have saved in all of your tax deferred accounts. And then an assumption on your tax bracket. So you can guess on that if you want to. There's literally a little slider button. It's pretty easy. Was it 22 or 24%? And then you'll enter that information in and it'll send off to you what you owe in taxes. That was Harley was just saying, please be sitting down. Do not be operating heavy machinery, because I think you're going to be surprised at how much you owe in taxes. From there, it's what exactly do you do with that? Is there any way that we can soften the pain of seeing what we owe in taxes on that, Harley?
Well, there's no way to necessarily completely take away the pain of it, because it's typically so big of a number. But what we can do is begin to start chipping away at it with a number of different strategies, whether that's Roth conversions, gifting strategies, any number of things that we can begin to implement that aren't necessarily going to cost us any more than what we're spending today, but be able to save us tons of money. I'm talking tens of thousands of dollars over somebody's life. That eases that person's burden, as well as anyone who may receive that money if something happens to them and there's still something left. Because at the end of the day, with those pre-tax, tax-deferred accounts, the tax bill is never going away. Whether you pay it, you out there, or your children, somebody is going to pay it. So why don't we do it now when tax rates are at all-time lows?
Yeah, all-time lows, and that's a very important point. We are in some of the third lowest tax brackets in U.S. history. Don't believe us? Look it up for yourself on the Magic Box. Go onto the World Wide Web and take a look to see what tax brackets have been throughout U.S. history. We are in some of the lowest right now. And we know that through the tax extension, which has been called permanent, we know those are at least going to be around for the next several years. Through 2028, probably 29 and 30. It would take a whole nother set of administration to come in and put in laws in place to change the tax rates. So right now, you've got a few years to be able to do some things like Roth conversions and to review it. It might feel painful to see how much you owe in taxes right now, but if you start paying those taxes in a lower bracket, you can continue to let that grow and have more spendability deeper into your retirement years. So go to that RDW tax test. Then call this phone number below and set up your appointment to get started on your own written financial plan for retirement. More Wealth in the Winner's Circle with Harley Shanklin right after this.
As a kid, I wanted nothing more than to be a hero. But little did I know I would actually get that opportunity, and it really started for me. The catalyst was 9/11. And as the war on terror continued to unfold, I put my money where my mouth was. And I ended up landing with the 101st Airborne Division and became a light infantry medic with them, and I spent a total of 28 months deployed overseas. I had the opportunity to serve with some of the greatest men and women that this country has to offer. And I had the blessing and honor to meet my wife through that journey. And after 10 years of serving in active duty, we started to build a family. Our son Leo was born. And I quickly realized that it wasn't the environment that I wanted to raise a family in. It meant moving around, and it meant risking my life in ways that may put me in a position that I may not be there to play catch with my son, right? To walk my daughter down the aisle eventually. And so I started looking for other opportunities, and that was when my father-in-law came to me, and he ran a financial planning and wealth management firm in Indianapolis. The relationships that he was able to build with his clients, it really resonated with me because I felt that same care with those men that I took care of overseas. And so I made the leap, became a financial advisor, and I like to think that I've continued that mission. Rather than their medical hero, I'm their financial hero.
Welcome back to Wealth in the Winner's Circle with financial advisor Harley Shanklin of the RDW Financial Group. Downshifting into retirement. The first part of the downshifting is we want to make sure that you've got a portfolio that matches your goals, your risk, but not completely taking the risk off the table. I mean, you could be in retirement for 20, 25, 30, 35 years. Maybe your spouse will be. So there's a downshifting, but it's not completely pulling on the emergency brake and stopping your portfolio at the finish line. If the finish line is that retirement, we still have a long ways to go. We talked about changing out the tires. That's maybe our taxes. We need to make sure that we're considering our taxes right now, saving tax deferred. We've been doing that for decades, but now we're in a lower tax bracket. But you also said eventually our body starts downshifting on us. What does that mean? How do we prepare for that, Harley?
Well, unfortunately, the shoulder pain or low back pain, that's just going to come along. There's not a whole lot myself or any other financial advisor out there can do for that. But when it comes to our health, right, we talk about Medicare and the challenges that come along with that and the understanding of what can be a complex and difficult to understand program out there. Go figure, the government creates something that's hard and complicated to understand. And what comes along with that also, when we talk about the healthcare piece, is the idea of long-term care, which none of us want. None of us want that, but the reality is 70% of us out there are going to need some form of long-term care. And the question becomes should you be a part of that 70%? How are you going to pay for it? How are you going to fund it? And Spike, oftentimes what becomes the concern isn't the spouse that needs the care. It's the spouse that's left at home.
Yeah.
Is their lifestyle going to be impacted? And for better or worse, we are still living in an environment where most folks that come down to sit with us, it's typically the husband that has more money in their accounts than the wife because they were either raising kids, something like that, where they didn't get to participate as much. And so a big part of our S.T.A.R.T planning process is to make sure that should something happen to the husband or whoever has the majority of the assets, that we're putting a plan together that's going to take care of not only them, but their spouse to make sure there's no disruption. Because I'm here to tell you, your daughter being a nurse or your wife being a nurse is not a long-term care plan. That is not a long-term care plan. That is not what they are there for. Even if they may be trained for it, they want to be there to help love and care for you and provide that emotional and spiritual support, right? Not just the caregiving. So we want to make sure that our plan looks at that.
It's almost a phrase that's been overused, but and it's taken away the power of it. But to say that you want to be able to retire with choice and with dignity. You don't want to be a burden on your family. So what does that mean? Putting together these financial protections for yourself so your family doesn't have to, so your family doesn't have to guess. So there can actually be, I know this might sound strange to folks, but some exciting, at least some positive tools to think about that can provide possible income and even long-term care protection, almost like having an insurance on your nest egg. Are you in favor of these tools? I've heard of long-term care riders that can be added onto insurance kinds of tools.
Yeah, and I know the word that you're dancing around.
I'm dancing.
And it's the A word, the annuities. And yes, right, that is an investment tool, a vehicle that we can look to help provide some of that guaranteed income and some protections should you out there encounter a long-term care need. And Spike, I often hear, well, Harley, if I give money to an insurance company, put it into annuity, I lose control. And I would argue it's the opposite, because what you're doing in the right structured annuity, you're actually giving yourself control, because you're ensuring that your income is going to continue, and that if something does come up like a long-term care event, that you have a tool there that is going to enhance the income that you're receiving and take a lot of the burden off of anyone who may be providing care for you. I would argue that's a lot of control, as opposed to if there's nothing in place, now you're putting those decisions to be made into somebody else who is concerned about you and your well-being. And it's much better if we can put together the right plan through our retirement S.T.A.R.T planning process, which is what we do with anyone who gives us the honor of sitting down with us, going through that process to see what is your secure income? How much are you going to be receiving from Social Security, pensions? When is the right time to take it? Looking at the taxes, how much of your money is going to be taxed, and are there ways that we can lower that bill? Looking at your advanced planning, that's your estate plan, making sure that your estate passes outside of probate as much as possible, risk management, to your life, health, and investments to make sure, should a long-term care event come up, that you have the tools in place to ensure that you're going to be taken care of. That then leads to that tailored investment strategy, making sure that all your investments are structured in such a way that if something does come along and happen, you're going to be taken care of.
It is such an interesting perspective that you said that some folks will feel like if you're giving your money up, a little bit of a portion of your life savings to an annuity organization, say, oh, I'm giving up control of it. And what you're doing is you're delegating the authority. You're saying, I want to take this function. You turn this into income for life that might have a long-term care rider on it. You're going to manage that. Then you have the wealth management version of it. Maybe some of our viewers are doing it on their own, but you're delegating that authority as well. It's hiring a professional to do something for you, just like you would get a mechanic to work on today's version of cars, right? It's that much more complicated, especially we're kind of moving into those retirement years, harder and harder.
Well, and and Spike, we can look at it in the same way that we view homeowners insurance, right? Homeowners insurance isn't something that you utilize, every day or even every year for that matter.
Yeah.
But we want to shift that risk over to an insurance company. When it comes to our income and our health, a lot of times that makes sense, that we can take a portion of the assets that we have saved up to this point, shift that risk and a little bit of those assets over to an insurance company that is then going to take on that risk to ensure that we're going to have all the income that we need for the rest of our life, as well as your spouse. And add on ancillary benefits should a long-term care event arise, that your income is going to be enhanced to help pay for that. So your spouse that's at home isn't left with that financial burden of trying to figure out just how to live, let alone care and support you.
We're all going to downshift into retirement a little bit, whether it's the activities, whether it's the amount of travel that we do, the amount of working that we do. You might even love what you do for work. You may have created your own business, but eventually we're all going to want to slow down a little bit. We've got to change what our philosophy is, whether it's the investments, the way that we look at insurance, and how we create income. That's part of the S.T.A.R.T program. We have less than a minute. That's all part of the complimentary call, sitting down with folks for 60 or 90 minutes, right, Harley?
That's exactly right. And here's what I will say on that, because when we get into retirement, part of our retirement start planning process is helping you out there figure out how you can enhance it so you can do more of that travel and all the things that you care about, but in a smart, efficient way, so you don't have to worry about running out of money.
And that's why we call it the S.T.A.R.T plan. Get started on your written financial plan for retirement with the team here of RDW Financial Group, right here in the greater Indianapolis area. You can call that phone number right now down on the bottom of the screen. We do have folks who are standing by. They'll schedule it for you. Or you can scan this QR code with your phone, open it up to the camera function, point it at it, and click on it, and you can schedule your appointment right there. Thank you for watching. Financial advisor Harley Shanklin of Wealth in the Winner's Circle. We'll be back next week.